Take a look what's happening in dollar yen if you switch up the board.
The fifth monetary policy review of the current financial year and the Monetary Policy Committee in its judgment has kept interest rates unchanged. You're watching Bloomberg Quint, and we are trying to see whether the RBI and the Monetary Policy Committee have done the right thing, what the rate cycle will look like. Is the rate cutting process over, at least for this cycle? Those are some of the questions. We'll be joined by some panelists to discuss through this. Saugata Bhattacharya, Chief Economist at Axis Bank, will join us. Aditi Nayar at ICRA will join us, as will Tushar Arora of HDFC Bank. That discussion coming up in a minute. But before I get to the discussion, just the brief highlights of the policy statement and what actually came off it. So there was no change in interest rates. That was on expected lines. There was also no change in the monetary policy stance, which remains at neutral and perhaps allows the committee to move in either direction based on incoming data. Inflation projection has been increased marginally to 4.3 to 4.7% for the second half of this fiscal year. Growth projection has been maintained at 6.7% gross value added growth. On liquidity, which was a prime concern for the markets, the RBI did not say very much, except to say that it knows that liquidity conditions have tightened and it expects neutrality to be achieved only early next fiscal year. Should it be required, they will use all tools, including open market operations, to either infuse liquidity or suck out liquidity as the conditions may warrant. That's the highlight of the monetary policy review. But let's now start to get into the debate and the discussion. Let me go across to Tushar Arora of HDFC Bank first. My question to you is, actually to both of you, is not so much whether this was expected, because I know it was, but Tushar, if you were making the decision, is this what you would have done based on the data you had access to?
Well, to be honest, I think RBI has missed the bus now. Some months back, when inflation was really going down and the upside risk related to vegetable prices and oil prices wasn't there, I think that time was the correct time to cut rates. Now I think it is a very difficult situation with inflation going up, with oil prices going up internationally, and especially November was a very difficult month in terms of vegetables. A lot of vegetable prices shot up, including some of the protein related items like egg and mutton. So at this moment, I think it's difficult to cut, and I would have done the same thing, I guess.
Aditi, you would have kept rates unchanged as well?
So, Ira, I think broadly when we look at the kind of volatility or the noise that we're getting in the monthly CPI inflation readings, this is always going to be an issue, because even small supply-demand mismatches in things like vegetables are going to create a lot of volatility, and it's going to be difficult to be able to see through that. So broadly, our view is that the MPC is always going to have a bit of a cautious bias when it comes to cutting rates, because when inflation collapses like it did in June, that's not really a signal that is going to remain at that low level. And the bounce back has happened pretty sharply, and in fact our view is that the November CPI reading is going to be above 4%. So given this kind of context, and certainly the uptrend in inflation that we're expecting over the next few months, November itself and then continuing on into the next few months, I think the decision to stay on hold is something that I concur with.
Okay, let's look at that inflation picture actually, Tushar, I'll come back to you. A lot of critics out there have said that the RBI continues to overestimate inflation, and in parts in previous months they have actually been right. Now the RBI is saying that we expect inflation to go well above 3.6%, which is the last number. They expect it to go closer to 4.5 and perhaps even above 4.5. Is that conceivable? Do you actually see that kind of upside? And if you do, is that largely coming in from base, or do you actually see the momentum of inflation also pick up from here on?
If I have to point out really the next number, November, we are looking at a number of around 4.5 to 4.6%. So that means inflation close to the upper end of the RBI's projected range. And if you go by the March projections, I think we have a number of around 4.6, 4.7. So that's again close to the upper end. So it's not something that RBI numbers are out of the whack. They're completely in line with the recent trajectory of vegetable prices, recent trajectory of oil prices, and especially housing inflation is also going up, which RBI has pointed out as one of the key factors of revising the inflation numbers. So I think we concur with the numbers, and we believe inflation is likely to remain close to the upper end of the RBI's estimate.
Aditi, you think all of the risks that they pointed out, and if you just look at the statement, they spend far more words in terms of describing the upside risks to inflation than they do on growth. All of those risks you think are justified? I mean, so they talk about the fact that food and fuel prices have already started to rise and those impact household budgets. They talk about, of course, risks emerging from the fiscal side. They talk about risks from the oil side, potential risks on the global financial condition side if that starts to play into the currency markets. Do you really think that each of those risks is going to materialize in a manner that inflation is going to go perhaps towards 5% come next financial year?
So, Ira, I don't think all of the risks will materialize, and certainly since the October policy, we've seen the GST rates being cut, and that's actually taken the edge off one of the risks that the RBI had highlighted in the past. So, all of the risks definitely may not materialize together. Vegetable prices, which are really on a major uptrend right now, may normalize in a month or two, and certainly that will take the, reduce the spike of the CPI inflation that we've seen in the last month and that we're expecting in November. Our forecast is a little bit lower than Tushar's. We're looking at 4.2 to 4.3% in terms of the CPI inflation reading for November, and that's factoring in that the pass-through of lower GST rates will have already started in that month. So obviously, even on the fiscal side, it's not like we're expecting all of the risks to the revenues and the expenditures of Government of India to materialize together, but certainly it's worthwhile or warranted to actually highlight all the risks which are there. On the growth side, I think the RBI did actually spend a lot of time on the positives or the upsides that it sees, the factors that have been put into place that would push up growth in the second half of the year and beyond. So I thought, in fact, there was quite a bit of space that was devoted to things like the recapitalization program, the referral of large distressed accounts to the IBC, the ease of doing business, etc. So quite a bit of focus on growth there as well, but primarily, of course, the objective remains bringing CPI inflation durably to 4%, and therefore a little more ink devoted on that side. In terms of the average CPI inflation, we expect it to be above, somewhere between maybe 4–4.5% in FY19. Partly depending on how the monsoon turns out to be. So we are not looking at an average inflation of 5% in the coming fisc. But of course, in some months, given the base and given sporadic volatility, it could touch 5% before receding back down.
Okay. I'm just going to request the two of you to hold on because we have the veteran in our studio now, Saugata Bhattacharya, Chief Economist at Axis Bank is with us. Saugata, welcome.
Right. Veteran meaning, planning retirement. Yes,
not at all. Veteran of the economy and monetary policy. Saugata, the questions you were discussing before you came in, I really want your views on this. So, we all know it was kind of expected. There was small constituency which was saying that, one rate cut may be possible this time around.
Right.
But tell me something. Is this what you would have done? Not what you expected the RBI to do, but what you would have done?
So I'm going to get killed. I'm telling you this. I'm going to get killed completely by the trader community, by my own traders. But probably, yeah, this is what I would have done. I think there's so much uncertainty in this current environment. Start from the global side. There's a huge amount of carry trade that was going on. I mean, all the portfolio flows that we had gone in. Now with the Fed likely to raise rates, certain to raise rates in December, with the 3 more additional rates, with the European Central Bank making noises about tapering their stuff. So I think there's too much at play in this current environment. Domestically, we have no idea about what the fiscal side is. The tax collections, we have to get some certainty on the tax collections. On the global side, again, commodities, oil prices are up. I mean, not likely to come down with all the geopolitics that is happening in the Middle East. Commodities prices going up. China beginning to structurally tighten their capacities. Growth, we don't really know. I mean, what are the impulses for growth going forward? How consumption is likely to play out? There are certain things that have definitely happened. I mean, the 3 major things that have happened since the last policy, the structural changes, the ease of doing business, the bank recapitalization, the Moody's ratings change. But given the kind of uncertainty that we are playing around in this moment, anything can go any which way. So at this point in time, particularly with the currency potentially likely to be under some stress, I think it would have been very, very unwise at this point in time to play around with the differentials, interest differentials, with the potential interest differentials in the developed markets with what is happening in India.
But that's, I mean, they didn't cite that as the main reason. I know it was one risk on the inflation paragraph.
Absolutely.
But they seem very convinced that inflation, or they seem far more convinced that inflation is going to surprise to the upside than they are about growth. I mean, on growth, their comments were very tentative and very sort of indecisive.
Right. So, but I mean, I don't think, frankly, and I'm going to get killed second time with this. I don't
You're
think...
already killed once, you may as well go for it now.
That's right. You can't kill a man twice. I mean, you know, except for the slow Chinese death. But other than that, a 25 basis point here or 25, 50 basis point is not going to move the needle either in inflation or in growth. So that's not going to happen. What is happening, if it's in the policy, throughout the policy, even more than inflation, it's fiscal throughout.
Yes.
And they cite their own internal studies themselves that inflation in India has become very level dependent on the fisc. So the worry is that state fisc not keeping up to whatever the targets are. Slippages on the fisc, fiscal slippages is very occurring. I mean, if you were to use big data, that's the one that would show up, fiscal slippages. So I think that inflation is definitely, because that's the control variable that they're mandated to control. But the underlying drivers of the inflation, which is one very large part of that, is the fisc, I think is topmost on their minds.
Okay. On the fisc, and this is coming to all three of you, but Saugata, I'll start with you. So, okay, so, if you're comparing what is going to happen in terms of fiscal slippage now to what happened after the global financial crisis, I mean, they're very different sort of quality of fiscal slippage, right? I mean, we talk about quality of fiscal consolidation, but
right.
Quality of fiscal slippage here is very different. Should that not be important to take note of?
No, of course. I mean, we are not talking of the fisc going back to 6% or 5.5%. I mean, that's...
Or even in the manner in which the fisc is expanding.
Even, I mean, this is not a crisis. I mean, we are not facing a fiscal response to a crisis. We are not.
Yeah.
But that path down to 3.2% of the centre's GDP, and forget the 6.2% or whatever of the consolidated fisc, that's been an incredibly difficult climb down. That trajectory, the glide path of that fisc down has been a very, very difficult journey. And given the sort of fragilities that we see in India, the role of the fisc in stimulating investment demand in particular, given that private investment is still unlikely to come in the next couple of years, I think that's what is the key worry at this point. It's not the fisc slipping to even 3.5%, but the signs that if the fisc doesn't slip, your expenditure needs to be cut. And your expenditure particularly, I mean, given the commitments that you have on the revenue side, the expenditures that you need to cut back on the capital side, that's, I think, the cause for worry.
That's a cause for worry, and I'll come to that on the growth side. Tushar, both of you are in Delhi. What is your sense? I'll start with you, Tushar. I mean, do you actually, think that this year's number is sort of now, it's a given that we'll miss this year's number? But then the question is, what could the next year's number be? What's your sense? I'm talking about the fisc here.
I think if you talk about the fiscal, meeting the fiscal deficit target and RBI's view on that, I think it's part of the bigger question of things which can be ignored at this stage. Things which can be ignored at this stage, one is the hike in HRA and the impact coming on housing inflation in general. And that's a statistical blip, I think, which will now normalize after a year or so. Secondly, the fiscal deficit, whether that fiscal deficit is moving out of the range because of the rise in capex or because of the revenue expenditure. If it is going because of the capex, I think it could be ignored to some degree. Also, as you pointed out, it is not a very big drastic change in fiscal deficit. If it happens, it might be going up to 3.4 or max 3.5. That's not a drastic shift away from 3.5 we had last year. So these are things which can be ignored, and this is the main question which I think RBI should be asking and discussing among the MPC members. As far as reaching the deficit target for this year is concerned, we did a detailed analysis a month back, and the kind of slippage we were getting at that point of time was around 0.4% of the GDP. Now things on disinvestments have picked up very well, so I think that number might come down to around 0.2, 0.3% of GDP, and that's the degree of cut in expenditure that I think a government will have to do to meet its fiscal deficit target. And essentially what we have seen in the last few years, that the last quarter government cuts down expenditure, and there are a lot of ministries which have still not spent money allocated to them. So I think meeting target is not a difficult task. I think they can do it with cut in expenditure and various other items. The thing is whether they're propagating a right story or not, whether they're doing this to meet growth, whether they're cutting expenditure on capex, or whether they are doing it on revenue. These are the details which I think bond markets look essentially, and also the ratings people look at essentially.
Yeah, no, but I think the concern is wider than that. Aditi, you had done, ICRA had done some interesting analysis on the states as well, because, this is not just a center problem, it's a state and center problem. And I think if you put the two together, exactly the point that Saugata was making, that if you start to see capital expenditure come off both at the center and state levels, if you want to stick to that fist, then there's a, sort of a compounding of problems on the growth side.
Absolutely. I mean, let me just start with a couple of points on the center's fiscal balances. The concern this year is really on the revenue side. I'm not that concerned about the expenditure side. I don't expect there to be any overshooting. That's not going to be the reason for a fiscal slippage in FY18. It's really going to be whether tax and non-tax revenues are able to meet the budget estimate. Now, to my mind, as far as direct taxes are concerned, dividends are concerned, and the telecom revenues are concerned, for these three items, we are likely to see some slippage as compared to the budget estimates. Disinvestment, we may well overshoot the budget estimate, which will take off some of the slack from the previous three items. And as Saugata mentioned, on the indirect tax side, as far as GST revenues are concerned, there is a huge amount of uncertainty as to whether we are going to be able to meet the target or not. So the issue on the center is going to be whether the revenues are going to be at the budgeted level. Expenditure will be difficult to cut. Revex can grow by about 7% in the remainder of the year on a YOY basis and meet the target. Capex in any case has been front-loaded and needs to be, on a contraction of more than 10% to be within the budgeted levels. So I'm not sure if there's really going to be a lot of space to cut expenditure to be able to offset any slippage in revenue. So that's on the central government side. On the state government side, the uncertainties are far worse to my mind. The research that you were mentioning, we had put out some weeks back where we looked at the kind of increase in state development loan issuance in Q2, which was more than 40%. So the total gross debt being raised by the state governments in Q2 was more than 40% higher than what they had done in Q2 of last year, which was really quite an alarming figure, and possibly to a large extent did indicate that there were a lot of cash flow mismatches after GST had come in, with the IGST revenues not having yet been shared with the states in the form of FCST. Now, coming ahead 2 months later, we've actually got a contraction of in SDL in October and November. So the uncertainties in that sense are really quite large.
Sure, Aditi. So I think everybody agrees that fiscal seems to be one of the biggest risks for the Reserve Bank of India and for the economy going forward as well. But I don't want to make this into a show about fiscal, so I'm going to go back to the growth side. And actually, if we can bring up a chart which the RBI put up in their for the expectation surveys that they put out later in the evening after the policy. Interesting and fairly sort of notable decline that came through in the consumer confidence side. Inflation expectations also higher, and we'll talk about that, but consumer confidence, if we can bring up that chart, there you go, showing a fairly steepish decline, Saugata. Consumer side of the economy not looking great?
Yep, I wouldn't be very surprised. I mean, and this is very different from the business expectations.
Yes.
The last one that I saw.
Yeah.
Businesses clearly are far more bullish, but they have to sell to somebody.
Yes, exactly.
Right. So, and this is the cause of worry, because I mean, if this doesn't improve, if consumer confidence and consequently consumer buying, consumption doesn't improve, then the capacity utilization gap that still exists in the system. I haven't seen the latest numbers yet, but I wouldn't believe that it's very far away from the 71% that we saw for the June survey. So if that doesn't improve, the incentives to invest still stay, for the private sector to invest still stay relatively weak. And that is where the role of the government again comes in. And the really peculiar thing is not just the revenue shortfalls, the potential revenue shortfalls, etc. It's just that the spending, the ones that I saw, I haven't seen that for October, for the September numbers that I saw, revenue spending, capital spending of the center. I mean, it's completely 31% for railways till September. I mean, 50%, 53%. So, I mean, as of this point in time, the ability of the government to absorb higher spending, I think, is far more important than just shoving money into the bucket. So that's one thing that needs to improve. The ability of the government to absorb the sanctioned spends.
Yeah. And in fact, if we just sort of connect this to the last round of GDP numbers, so the two places where you saw slight, sort of unanticipated weakness, not unanticipated, but weakness was government, finance linked.
Absolutely.
And also consumer. I mean,
that's right, consumption. Yeah. So, so it is consumption that has actually held up, which itself raises a question. So consumption would typically, I mean, at least a large part of the urban consumption would come in from the corporate spends, the salaries, wages that all of us draw. And we've seen, I mean, from the corporate numbers, the set of 4,000, 4,500 companies that we track over the last 4 or 5 years, that the salaries and wages growth has really come off in the last 4 or 5 years. Yeah. So what it is that is holding consumption up, because it is consumption that is holding whatever growth rate we have in the GDP up. It's been shuffling around 4, 5, 6, 6.5%, 7%. So what is it that is keeping that consumption up till we understand what that driver is, and consequently policy to adjust to keep that consumption level up or even accelerate it going forward? That, I think, is one of the key reasons that we economic analysts need to figure out.
Okay. So what happens, Saugata, if some of these additional pressures start to play out on growth and you don't get numbers which even allow you to meet the 6.7% GVA growth target for the current fiscal? Do you think they've left a little bit of, I mean, they've left a neutral stance, and in that policy statement they talk about the output gap. I know it's not that easy to understand the concept or the exact output gap, but they do seem to think that persists, and hence could be a reason to cut rates.
It has to persist, because I mean, given the capacity utilization levels that I'm sure we'll see even for this quarter, that output gap has to persist. So what do we do about it? I mean, that's something which has been engaging policy discussions for a long while. And I think we had talked about this the last time round, the drop in investments. I think, again, it's coming down to that, to the housing segment, to the construction, and coming in from the housing segment, because I don't think, I mean, look, for one thing, over the next couple of years, I think we will begin to get some tractions from the large infra projects that is in progress.
But that's next couple of years.
Next couple of years. I don't think you're going to get too much of a growth impulse. Whatever, I mean, for one thing, I think even in FY18, I think we are likely to be pleasantly surprised from that 6.7, 6.8% growth that we are now forecasting, because I'm quite sure that once the revised data for FY17 comes in, that number will be pulled down.
Oh, so then the FY18
and that gives a boost to FI. So, I mean, I wouldn't be very surprised if we actually hit 7% in FY18. But then going on from there into that 7.2, 7.3, 7.5 range over the next couple of years, what is it that is likely to drive? Some part will definitely be consumption, led by the government. So the states will come in, try to, with their stimulus spending and so on. But together with that, I think the government now needs to focus immediately on the affordable housing bit. The second thing that I remember we were talking about this, the Saubhagya scheme, the rural electrification scheme, because that is likely to pull in a range of consumer durables into a hitherto untouched segment of consumers. So all of these things will have large employment trails, consumption trails, salary trails. So I think those are the two segments that the government should focus on.
Aditi, what is your sense of growth? I mean, you're convinced we'll meet that 6.7% GVA number, and some of the factors that Saugata was talking about, do you see those play out as well?
So we're actually a little bit lower than 6.7% now. Couple of reasons for that. One, the Q2 numbers were slightly lower than what we had penciled in, and also looking at Q3, there are a couple of reasons that we don't think the uptick in GDP growth or GVA growth momentum is going to be very sharp as compared to the numbers we've already seen in Q2. One is that we'll get the full impact of the Kharif harvest in Q3, and also higher crude oil and commodity prices are possibly going to eat into corporate earnings across the board, and that could be another reason why we don't get a very sharp uptick in GVA growth in Q3. We are looking at GVA growth crossing 7% and being well above 7% in Q4 once we get the full impact of the base effect. Now, of course, if we get a revision, downward revision in FY17 GVA, that pushes up FY18 GVA growth to some extent, then I do think 6.7% is manageable. But as of now, looking at how commodity prices have moved in the last couple of months, I think it's going to be a slower than expected growth in Q3 that's going to pull down overall GVA growth for this year below 6.7%.
Okay, and you don't think, Aditi, that that would then allow, maybe prompt the RBI to cut rates? I don't know if it will happen in the February policy because we won't have the GDP number, the next GDP number before the February policy. So maybe April, unless, of course, inflation is, sort of above 4% and they can't afford to. But if you get a softer growth number, is there any room for the RBI to cut rates is what I'm asking?
So if it's significantly going to undershoot the 6.7%, if that's going to be very clear by April, then perhaps Feb policy is not only going to be right after the budget or right around the budget, but also we're not going to have very clear Q3 GDP data by then. We'll have the advanced estimates because those have to be ready before the budget, but I don't think we'll have the Q3 numbers, or if we do, they'll come so early that most corporate earnings won't be there, so they won't be a very representative sample of what's actually going on in the economy. So I think February growth, it'll be difficult for the RBI to cut rates based on softer than expected growth at that time.
Okay, I have two last issues before we wrap up the show. Tushar, I'll just come to you for a quick question on liquidity. Don't want to spend too much time, but I know you look at the markets closely. Do you think the RBI is making a mistake once again on liquidity management, or at least communication of its liquidity stance? Because today they weren't as soft as the market would have liked them to be. I mean, they talked about the fact that yes, they'll keep liquidity comfortable, that they expect it to become neutral only early next fiscal. But they also said that liquidity is not as tight as perhaps people in the market are making it out to be. That could keep rates, at least in the market, high no matter what their stance is.
See, there wasn't much in the policy statement, but I think during the press conference, Viral Acharya mentioned a bit on liquidity, and he's actually true to the extent that liquidity is not in the deficit territory. It is not close to zero or close to neutral territory. It is close to 1 lakh crores in surplus now, and part of the reason because cash balances available with the RBI for auction by the cash balance of the government, that is still there, and because government is now spending less, I think that is likely to remain the position of the cash balances of the government. So surplus is there, and I think what RBI pointed out that OMOs can be now done both the directions, and that's I think was a bit of easing. I think easy stance which RBI not maybe communicated was willing to communicate, but markets read that way, and yields maybe went down for 3 or 4 basis points today. So I think liquidity wise, I think situation is likely to remain unchanged for quite some time now. I think at least until March.
Okay. Just, one last point of debate, and I'm going to stay with Saugata on this one. Saugata, if you can just bring up that chart again that we had. My question to you is what this rate cycle will look like. So even if one assumes that it has flattened out at, at 6%, how quickly will we start to see the repo rate now move up? I ask because, we are in a slightly different scenario. We're in an inflation targeting scenario now. So one, if they want to stick to that midpoint at 4%, perhaps the rate cycle will turn faster. Right. On the other hand, if we have managed to keep a lid on some of the underlying inflation pressures, maybe we'll have, not much of a bounce back even if we start picking up.
Complex issue. I know.
That's why I came to you on this.
I know, but I have a feeling that we are not likely to see a rate hike anytime in the near future.
Not even next fiscal?
Not even next fiscal, because I think growth is still too fragile. I mean, with the potential output that we are talking about, the capacity utilization that we are talking about, there's absolutely, unless something goes horrendously wrong in the global arena, the oil goes to 80 or something, which is unlikely for extended periods of time. So unless something like that comes in from the external side domestically, of course, I mean, there are risk factors with poor monsoon pushing up food prices and things, but the government has demonstrated that it has the capability to keep things more or less tight. So structurally, I think inflation is beginning to move structurally towards the 4% target. There will be deviations here and there. But my worry in this is that one major thing that is likely to happen is that from the farm side, the Prime Minister Modi's program of doubling farm incomes, I think that will need to shift focus from the erstwhile consumers, us, because the government has always favored till now the urban consumer. Whenever prices were going to go up, I mean, imports were allowed, exports were shut down. I think that focus will need, the terms of trade will need to shift towards agriculture in order to incentivize farmers to produce more. That's one large part of the doubling farm income. So, and that is unlikely to happen very quickly. So, other than that, all the other structural features of the domestic inflation, domestic realistic price for setting and formation. I think that is likely to keep inflation more or less under check. You will see inflation go up very significantly in FIs. As Aditi was saying, our sense is all the way up to 4.9. The average will be 4.9 for FY19. But out of that, about 50, 60, 70 basis points will be the potential HRA increases from the states, which they have mentioned in the policy as well. So if you don't see the states increasing their HRAs, it's going to be much, much more contained. But even if they do, unless it spills over into the secondary markets, my sense is that the RBI will look through that inflation. So growth is still too fragile now at this point in time to try to move rates. And liquidity, that's another complex question that will happen, because I think you will get a fair bit of liquidity in the system. We are about 36 billion dollars are likely to mature in the forwards market, part of which will come into the system. The MSS papers will come into the system. That's another lakh crores, so 2 lakh crores from the forwards, 1 lakh crore from this. So I think liquidity will still be relatively ample. But that's a whole dissertation thesis ahead. But I think market rates will still be stable. Growth will remain too fragile. I don't think we are looking at a repo rate increase cycle. What the other rates will do will depend on a host of other factors.
Okay, so we could be in a flattish repo rate cycle
for some time.
All right, I think we'll have to end on that note. Saugata, Aditi, Tushar, thanks so much for joining us. That's the Monetary Policy Review, the 5th of the financial year. The last one comes up in February. Thanks for watching Bloomberg Quint. Go to the website. We've got a whole host of views and interesting commentary on the RBI and on the Indian economy. Thanks for watching.